What if I told you that not all that glitters is gold when it comes to recommendations made by fellow physicians? Sounds juicy. Keep listening as we dive in. Welcome to the Money Meets Medicine podcast, where we talk all about the personal finance topics you wish you had learned in medical school. I'm your host, Justin Harvey, and here is your co-host, the one-armed bandit himself, whose family is dropping like flies, Dr. Jimmy Turner.
Yeah, it's been interesting as I record this. For those of you who are going to watch this on the YouTube channel, which we're opening back up, putting shows back out there. I have a sling on, had shoulder surgery, but right before that, my son, my middle kid, was in a boot for 3 weeks because he had this Sever's disease of his heel, like growth plate issue. And then my oldest is now on crutches and in a boot because she has probably a growth plate or a stress fracture in her tibia. And so like 3 of my 5 family members have been in a medical device of some kind in the last month. So it's been quite the whirlwind for us. But yeah, that's how it goes sometimes, man. So I'm really excited about the show, Justin. We're going to talk about recent happenings in the physician finance space. And these are things that are kind of making waves on social media that I think are important to talk about as examples of things that can happen, in particular with recent syndication deals in the real estate space and capital calls. We'll talk to you about what a capital call is and what causes those sorts of things, and how this unfortunate event is leading to a lot of doctors losing 5-figure sums of money often in these deals. And so we're going to talk about it. We're going to talk about what you can learn from it, how to avoid these things, how to maybe notice when maybe it's not the right thing for you, and how to prevent this from happening in your world. We're also going to discuss some other news that's making national headlines actually in next week's episode on life insurance. So it's kind of a back-to-back 2-part series on financial faux pas in the industry, one from the physician community and then one outside the physician community. And the combination of all of this makes me want to remind listeners just that really we're here to teach you about money. And at the end of the day, that is what we're trying to do, to educate you, to protect you from what's going on. And whenever someone is teaching you about money, ourselves included, or advising you or trying to sell you a product, you need to understand very clearly how they get paid. In fact, understanding this would have prevented my biggest mistake that I talk about a lot on the show in terms of trusting a disability insurance agent when I was in medical school. And that mistake led me to applying for the wrong kind of disability insurance. Because of that, to this day, I still can't get it. And that's why we created Money Meets Medicine disability insurance. So really, essentially, what happened to me would not happen to other doctors. In fact, our denial rate at Money Meets Medicine disability is less than 1% in an industry where the average is something like 20 to 30% in most of the other companies in this space. And even our biggest competitor, White-Coat-Investor, recently wrote an article discussing their 7% denial rate, which is much better than the industry average, but nowhere close to what we're able to do. And there's a reason for this. And the reason is because our gold standard, our North Star when it comes to this stuff, is doing absolutely everything we can, including sending clients out when it's what's best for them and makes us $0 so that we can prevent what happened to me happening to other doctors. So in this episode and in next week's episodes, we're going to talk about conflicts of interest, allegations of fraud, getting bad advice. And so let this serve just as a reminder that if you don't have disability insurance and you aren't sure who you can actually trust, you can go get a quote from moneymeetsmedicine.com/disability and we will take care of you. So Justin, 2 different stories. We'll talk about story 1 this week and we'll talk about story number 2 next week. Interestingly, I mentioned that they're both 2 topics of episodes because I saw both of these stories within the same 24 to 48 hour period, which I found really fascinating. And maybe I'll preface this first story with some of my observations, which I've shared on the show multiple times in the past. So this isn't new in terms of what I'm about to say. I mentioned that because of what's happening, and I don't want people to think that this is the first time I'm having this take. But for several years now, I've basically pointed out that people selling real estate courses or people offering these real estate syndications and deals, particularly in the physician space, particularly by physicians, has kind of rubbed me the wrong way. And the reason why isn't because I don't like real estate. It's not because I don't think courses are a bad thing. Educational content's good. It's because these things continue to be offered in the face of rising interest rates and rising home prices and just real estate pricing in general. And they continue to be pumped, even when it got to the point where it was pretty obvious to me that it was not wise to be taking that route anymore. Now, if you go back to 2020, when interest rates were 0 and deals were great, like that was obviously a different time. But the fact that these things kept getting pumped after those times changed was always a problem for me. And so for multiple years, I've basically said, don't do it. I don't think it's the right thing to do because of the change in the environment. And should prices come down and interest rates come back down, maybe this is something that makes more sense. I just want to call that out because this is something you and I have discussed in the past before we go into the story. But have you heard about the story before I sent it to you?
No, I hadn't. That was the first that I had seen this. And like I said, when we had our little text exchange, all the things that I thought before, I think them even more now.
Yeah. So for some background, for those of you that don't know, I saw a post by Tyler Olson. He's a financial planner I've actually had on Money Meets Medicine before. Friend of mine, someone I trust. I think he's a great guy, does good work. And he's got a pretty significant X following. And he had this post. I'm going to quote it. He said, "You'll get passive income," they said. "You can trust us. We're physicians just like you," they said. "Financial independence is just around the corner. All you have to do is invest in our affiliated real estate investments," they said. They were wrong. And what he's alluding to in that post is that there's this picture from a particular group that I'm not going to name in this episode that emailed their investors and said, "Hey, we want to let you know this deal, based on the valuations that we're getting at the moment, it is very highly likely you're going to lose your money. It's an equity deal. So the debt investors get paid first, equity's left after that. And so these equity investors are going to be left with nothing." And it gets worse when you follow this rabbit trail on Reddit, because there are people that talk about, I don't know if it's the same exact deal, maybe it's a different deal, which would be even worse, that people are having capital calls to the tune of, "Hey, I invested 50 grand into one of these real estate deals at the same company. And they're saying, if you don't give us more capital, then you're not going to probably have the chance to get your initial 50 grand back." Also knowing that if they put more capital in, there's still a chance they lose even that in addition to their $50,000 they originally put in. So this led to some conversation in the social media circles that I swim in, questioning these deals and whether they are an example of affinity fraud. And I thought that was interesting, Justin. Have you ever heard that term before, affinity fraud?
I hadn't, but it was a phenomenon that I had observed for a long time, and we'll call it a moral hazard. So it's not always bad when a doctor gives a doctor advice, or I also see this in like faith communities where it's like, I'm a Christian, I'm a Jewish, I'm a Muslim advisor, and I have expertise in helping people of a certain faith or affinity group have a financial life and have investments that have reflect the values of that faith community. But the hazard is that people are not as buyer beware oriented. They're like, "Oh, look, you're in my club, you're in my affinity group, and therefore I'm not doing the normal level of due diligence I would do if you're just some random dude who knocked on my door and said, 'Hey, I got a thing to sell you.'" The fact is, yikes, I see a lot of stuff coming from those corners of the world where there's not enough due diligence on the front end, and it can be at worst like exploitative or fraudulent, or at minimum like, dang, this was not rigorously implemented. This wasn't the best thing you could have done. And perhaps if you were as aggressive with your due diligence as you would typically be, especially physicians, they're like very process oriented, data oriented. Like maybe you wouldn't have been here.
Yeah, no, I agree. And it's interesting, when I looked it up on ChatGPT for the definition of affinity fraud, one of the things they specifically mentioned was faith-based groups. ChatGPT also at this point, it's kind of scary. It gets to know you. So it knows that I have a podcast. And it knows that I'm a physician who has a podcast specifically on financial literacy for other physicians. And so the definition for affinity fraud it gave me is that it's a type of investment scam where the scammer targets a specific trusted group and uses that social bond, trust, identity, shared belief system, or shared professional identity, so doctors, to manipulate them into investing. And I was like, wow, that's kind of hitting home. And like, I'm not saying this, like I was not the one that made this claim on Twitter. I am not the one making this claim right now that I think that this is an example of affinity fraud with these deals that are going on. I think that personally, I know some of the people behind these deals that they're actually good people. They're probably well-intentioned. That said, there were some promises that were made that people are probably upset about, because you even pointed out to me when you went to the site that they have this thing on there that says, "We help you build wealth through low risk, high growth real estate investments in strong markets throughout the US." I'm quoting that. And for me, I was like, man, like maybe I have a different definition of low risk, but when you have people saying they're having capital calls and that they're not going to get their money back, like whatever kind of investment that was by definition not low risk.
Yeah. And I have so many people tell me, like, I don't want to just invest in the stock market, which fine. Let's consider the whole universe of potential investments. But at least here in America, since we started keeping track of it, like IVV, VOO, those tickers that we associate with the S&P, like those don't go to zero. I mean, they get cut in half in a bad year, but the American economic engine has kept on churning. But that's my biggest beef with these illiquid, opaque, often expensive, and it could be real estate. Right now we're talking about real estate, but it's a lot of other things too. They do go to zero. And as the stock market is going down, at any point, you could hypothetically hit the eject button if you wanted to. But with these, you can't ever hit the eject button. You just find out after a year or 5 years or however long the lockup is, find out the result. And it's much more hazardous for the investor as a result. And it's much riskier.
This honestly feels more to me like options trading. where you're making a bet that it's going to go a certain direction. And in the midst of that, if you're betting on margin, sometimes there's a margin call. And so to me, we're with the S&P 500, if you keep your money in, technically, unless you sell, it always has the potential to go back up. And history would say that it in fact will and does. Now, you can't guarantee that 100 years from now, but for the last 100 years, that's what it's done. And so it's really fascinating. And the other thing too, is if you're going to be in this liquid, opaque investment, it needs to provide some outstanding outsized rewards. And on the site, they had $450 million in assets they'd invested in and $5.5 million in distributions. Now, I don't know what the denominator is of or how many doctors that they've got to invest in these deals. But if you do the math on $5.5 million distributed from $450 million in assets, that's not a very large number. And you are honestly probably doing better in the stock market given those numbers. And so when you give up the liquidity of your money, you give up more traditional investments, and you're doing that while chasing supposedly lower risk, higher rewarding, which by the way, those things don't go together in investing typically, low risk, high reward. And this is what you get, right? And so I think it is just a moment to reflect on these kinds of things because they get put in front of people all the time. And so I want to talk some lessons, Justin. Maybe we can just bounce them back and forth on some of these. But one of them is, we've mentioned this before on the show, but I think it's important to call out, particularly in this example, is the definition of an accredited investor, right? So none of these deals land in front of somebody that's not an accredited investor. And I'll tell you what the definition is here in a second, but the idea behind an accredited investor is that the regulatory bodies want to make sure that deals don't land in front of people that if they went south and they lost their money or they had a capital call, like happened in some of these deals, that they wouldn't, in their opinion, be able to financially come back from that. It is a safety measure to protect investors. And so because of that, these deals, by definition, are riskier deals because the regulatory bodies are trying to protect people from putting risky deals in front of people that can't financially afford to have bad things happen to them. And so the definition is an income greater than 200 grand if you're an individual, 300 if you're married, or a net worth greater than $1 million. There are other ways to obviously become an accredited investor. You can have licenses of certain kinds and that sort of thing. But for an individual who's not in the industry, those are kind of the two most common ways to become, quote unquote, an accredited investor. And if you get a deal that requires you to be an accredited investor to be looking at it, you should think in the back of your mind, this must be a really risky investment opportunity. Now, you may decide to still proceed, but you shouldn't look at that deal and read words like low risk when you are required to be an accredited investor to invest in them.
It's a great point. I was actually talking to a client this past week who said, Justin, I'm excited. I've finally reached accredited investor status and I want to see what's out there, which fine, great. Like, let's look and see. But I noticed that they had in their mind that they had attained this threshold that was like a new opportunity for them that was going to be a good thing. And I was like, this is actually just introducing a bunch of hazards to you that are probably going to be nothing but landmines to your wealth building journey. And sure, sometimes you get some winners and that's great, but the types of investments that these represent, they just require a lot more sophistication and care, and you need to size them appropriately. So in terms of other lessons, this is one that I would throw out there is sizing these types of investments appropriately based on your net worth. Meaning, what percentage of my net worth should I put in an investment that could go to zero? If we take what we have shared to as a stipulated fact that the stock market, it is volatile, but it will not go to zero. That's sort of one alternative that we would consider. Another alternative are these LPs, limited partnerships, real estate, oil and gas is another big one that I see a lot. And I would even put crypto in like a separate category, because if I buy Bitcoin today and I don't like it, I can still get my money back depending on how I custody it and things like that.
Yeah, absolutely.
But with these illiquid categories, like I tell people, like 2 or 3% of your net worth is all I would recommend. And once you're worth 10 or 15 million bucks, like you can do that math and you can have a 6-figure. It doesn't matter if this apartment complex doesn't work out for you, like you got the other 14.8 million, you're going to be fine. But if you've got student loans and your first handful of years into practice and you maybe just bought your house, you still have a big mortgage and your net worth is like $400,000, I have yet to see a case where I think that this is a good idea for you. I think you should have well into the 7 figures of net worth before you should consider things like this, just because of what's 50 grand on $1 million that's a 5% of your net worth on a single thing that you might not be able to sell. And maybe that's acceptable for somebody who's making a good income and building net worth quickly. But I would say that we should look further out in your net worth journey before we start adding in things that are more speculative.
Yeah, no, I completely agree. And I think it's important to call out that some of that comes from a desire. Actually, I'd say most of the time when I see physicians start investing in real estate, this could be active real estate, owning properties. It could be syndications and short-term loopholes for rentals and all that sort of stuff. Almost universally, the reason that people are doing that is because they want to get to financial independence faster. They are tired of medicine. They want to have the financial freedom to walk away. And maybe that doesn't mean they will. Maybe they just want to have the ability to, or maybe they're miserable and they really do want to walk away from medicine. And so they're looking for, how can I get there faster? And so I'm going to invest 50 grand when I only have $500,000 in net worth, because you know what? That $50,000 has the potential to do better than putting it in the S&P, which is going to take 20 years for me to get to financial independence. And I just don't have the ability to withstand my current career in medicine for 20 years. And I think it's important to go back to your why and figure out, okay, what is your reason for investing in these things? Is it FOMO? Because you think you see other physicians doing this and like they post on Instagram that they've got this amazing life and that they're traveling to Dubai this week. Is it because you want to get to financial independence faster? What exactly is the reason for that? And if you figure that out, maybe you could be a little more creative about, okay, well, how could I achieve this goal in a way that is a little more reasonable and a little less risky? Maybe it's about cutting your lifestyle back so that you need less money, right? Maybe you don't need to quit medicine. Maybe you need to go part-time and figure out a way to do that. Maybe you need to start doing locums. There are other ways to solve this I'm not happy in medicine and want financial freedom faster formula that don't involve opaque, illiquid investments. And so I think that going back to that's really important.
Yeah. And it's all about shrinking the dispersion of potential outcomes. You might hit a 10 bagger. It goes up 1,000%. And maybe you do get the winning lottery ticket with whatever your LP is. But what is the reasonable expectation of this return? And how much risk are you taking? And is it much more likely that if you were to just pick up a side gig or start doing some of those 1099 work and stuffing an extra 75 grand into a taxable investment account or a solo 401k, like if we think about things statistically on a risk adjusted basis and increasing savings rate versus trying to buy speculative investments as possible mechanisms for moving in the right direction, like savings rate increase, especially early in your journey, is just so powerful. And it's so much more
Agreed.
important than almost anything else that you could be doing, that if you're not looking at that first, then I think the good news is there's low-hanging fruit for you to say, what do I need to do to boost my savings rate?
Yep, I agree. And another thing I want to call out specifically, and this is something I'd say in front of every single lecture that I ever give. So I do this to myself, to be clear, because I think it's the right thing to do. And if you haven't gotten to know me yet, that's kind of my MO, right? So I'll give a lecture and I disclose my disclosures, which I'll talk about in a second. And as part of that, I tell people whenever someone is in front of you talking about money, they're teaching you about money, they're recommending you products, you need to follow the money and you need to specifically ask them how they get paid. Because that'll help you figure out, is this really a good recommendation? Or is this something that's just going to make that person selling it to you money? Because oftentimes what happens is people go in pursuit of these financial independence tricks. They say, hey, I want to get to financial freedom faster through passive income. And what they don't realize is that they've just become the passive income for the people that they're buying products from, right? And so when someone gives you advice, ask them specifically how they get paid. So for you, Justin, you make money giving financial advice. You're a financial planner. People pay you to give advice. You do not sell products. And so when you're talking about products, disability insurance, term life insurance, that conflict of interest, that moral hazard doesn't exist for you the same way that it would for someone who sells products. And so for me, I'm a licensed insurance agent. Yes, I practice medicine. Yes, I have a financial literacy business. But when people need disability insurance, we built Money Meets Medicine disability insurance with my buddy and partner in crime, Mike Kittner, after I got sick of sending people to other agents and watching them get denied because the right thing wasn't being done for them. And so I felt like that should be pretty much a never event. It's not a never event, but for us, it's less than 1%. It's almost a never event. And for a long time, I'd educate people and then I'd recommend certain agents. And I had a hard time finding agents that would actually do the right thing, which is why some people have denial rates that are 7 times what ours are at Money Meets Medicine. That said, it's a business. And so if you purchase disability insurance through Money Meets Medicine disability insurance, I'm going to get compensated for that. And you should know that. You're listening to this show. You should understand that I own that. And I get compensated when people buy disability insurance through Money Meets Medicine. So when someone's talking to you about money, whether it's a real estate deal or they're giving you a personal finance talk at your residency program for grand rounds or otherwise, you need to understand fundamentally how that person makes money. And then you'll understand why they're asking for email addresses, phone numbers, names, because their business model requires them to obtain those things in order to make money from you. So I think that that's really important.
Yeah. And the best insurance people that I know, they all earn commissions. And that doesn't mean that you shouldn't work with them. And it doesn't mean that they're not going to do the right thing. My preferred approach is find the best people and then work with them in the context of trust to be able to get things done. And to be honest, I've seen situations where the commission incentive, if you could call it that, like for my clients, when I say, okay, talk to Mike or talk to one of the other folks that we trust and get this done. Like I like that insurance people follow up because it's hard to get insurance put in place because nobody wants to do it, because sitting down and soberly considering your death for a while, then taking resultant action to get protection put in place, like that's on nobody's short list of favorite things to do. And so having this compensation mechanism, frankly, it's not the worst thing in the world. And I have seen it's like, oh, this is like a flat fee insurance consultancy, or we don't do commission, we do salary for all of our people, and it's more agnostic. I don't really want that. I prefer to know what I'm dealing with and then have someone incentivized to do the thing that we want. And so as a physician who's trying to understand where the money is flowing, you should also understand the incentive. And it's good to have incentive in the right direction. There's a lot of different models for financial advice and asset management and the AUM fee. This is another area where this applies. If somebody's charging a percentage, which APM Wealth does charge for clients that have investments to manage, we're incentivized to have our clients' investments be worth as much money as possible. And when our clients lose money, so do we. Now, there's no perfect fee structure, but there is a fundamental alignment of well-being that our clients observe and appreciate. And I guess people that want a different incentive, they opt for a different model. But having that incentive in place is, I would argue, like it's good for you. It's good for consumers to have that. Like I'm pushing and I'm trying to protect on the downside, and I'm trying to make sure we have the right equity exposure. And I don't want things that are not a good fit for my clients. And so there's a lot more that could be said here, but understanding how the money flows and the incentive of the professionals who are participating is sort of, it's table stakes for being able to make an informed opinion about which professionals you're going to be working with.
Yeah, you actually reminded me, another reason why we created Money Meets Medicine disability insurance was literally because in the United States of America, it is not possible to buy an insurance product without paying an agent commission. All agents earn commission selling insurance products. That is the way that it's sold. Maybe someday it'll be different. I'm not sure. But for me, when I realized that there's not like a flat fee way to do this, every doctor needs disability insurance. There's not a flat fee way to obtain that for them. And so that was one of the realizations that actually led me to create it, because it wasn't going to be impossible. It was going to be impossible to remove any of that conflict or incentive that existed that did push people to do things that I didn't necessarily agree with. And so it's one of those things, if you want to see it done right, you got to do it yourself. But yeah, so before we head out, I did want to mention that we've spent a lot of time revamping things at Money Meets Medicine lately. So this includes newly released content on our social media channels, Instagram and X, as well as a new weekly update. That includes this week's content. So blog posts, YouTube channel, obviously the podcast. And that weekly update now includes educational personal finance lesson for the week and where you can find exclusive deals offered to the Money Meets Medicine audience. So if you need a $100 discount on your student loans, for example, there's information in there on how to get that. And so if you want to join that update and get access to all the things, go to moneymeetsmedicine.com/update, punch in your email address, and then you'll start getting those updates the next Wednesday after you subscribe. Looking forward to talking about next week's topic, which is related to this one in terms of financial faux pas in the industry. I think you'll find that one just as interesting as this show. We will see you next week. Cheers.